Actually, today we are back after missing 1 month of webinars, but nevertheless, we're going to now continue until October. Today, we will be talking about the top 10 transfer pricing tips for manufacturer, distribution, and service providers, which is basically the traditional industries that are quite common in the context of business models and transfer pricing. Nevertheless, they have their own transfer pricing challenges that are worth discussing, and hopefully for all of you who are dealing with transfer pricing as part of finance or of tax, we can give you some input and some tips today. Before we deep dive into detail, let me just do a brief 1-minute introduction. So our firm specializes in providing transfer pricing advisory to multinational groups in Malaysia, Singapore, Australia, and within our 3 offices, we covered the Asia Pacific region. As I said earlier, we have 3 offices. Our head office located in Australia, our Singapore office, and our Malaysian office. We have been in business now for 15 years. This year is our 15-year anniversary. And apart from obviously doing our consulting work, we are frequent contributors to different tax journals. We also do a lot of training, not only these webinars, but other workshops with the government bodies. And we have a bit of a surprise at the end of the webinar, which we will share some very, very hot off the press news about where we're going to be doing some workshops in Malaysia. I think with that, I will allow Hon Chuan to introduce himself for those of you who don't know him.
No problem. Thanks, Adriana. Hi, guys. Thanks for joining us. I'm Hong Chuan, the director of TPS Malaysia. Just a quick, brief introduction. I've spent more than a decade helping multinationals with their transfer pricing issues. And as of now, nothing has backfired so far, and I intend to keep it that way. So today, I hope Adriana and I would be able to provide you with more insightful TP knowledge on today's topic. Back to you, Adriana.
Thank you, Hon Chuan. So Hon Chuan is at the moment in KL, and he's our technical lead in Malaysia. For those of you who don't know me, my name is Adriana Calderon. I'm the director and co-founder of Transfer Pricing Solutions Asia and Malaysia. I have been practicing transfer pricing for about 15 years plus. Prior to that, doing a little bit of domestic tax and international tax with Big 4 and mid-tier firms. Over the past 15 years, I think I have come across probably almost every single transaction that a multinational group can enter into. So hopefully we can share some practical experience today with you all. So with that, maybe let's just enter into the topic. I guess we will go through some of our top tips first, talking about a brief overview of what we consider is critical to take into consideration when addressing business models. Then we will talk about some of the key considerations from TP point of view, and then we will go through some case studies to address the 3 key areas that we are meant to cover today, which is basically services, manufacturing, and distribution. Then we will talk and wrap up with some key takeaways. And finally, we will allow about 10 minutes or 15 minutes of questions. So I think with that, I can pass it on to you, Hon Chuan, and maybe you can start going through what is the importance of a business model. I can see we have first a poll before you enter into the detail, and this is more to gauge the level of understanding of the participants today. So it will be great if everyone can spend 1 minute participating in the poll, just to get an understanding of what people has an understanding of the importance of business models today. So the question is, why is the business model relevant for TP or transfer pricing? And the options are 1, allocation of risk drives attribution of profit. 2, allocation of profit should be based on commercial drivers. 3, the value contribution drives attribution of profit. And finally, all of the above. So we'll see how we go. Okay. We are now at 1 minute, so I'm just gonna end the poll and launch the answers. What do you think is the majority, Hong-Chan?
All the above.
Okay, so let me just end the poll and share with everyone. So you are right. The majority of people have chosen all of the above, but I guess what we wanted to kind of bring to the attention or to the table very early, now that Hong-Chan is going to start going through the importance of planning to the business model, is the fact that basically, even though TP is related to tax to some extent, planning your business model in advance is equally important, because you kind of have to do a pre-homework exercise to be able to delineate where your risks are, where your value contribution is, and where your profit should be. With that, maybe I just let you start with talking a little bit about this concept of allocation of profit, risk, and business model and TP.
Thank you, Adriana. Well, I guess before we proceed to go through the nitty-gritty, I think that we first need to know why we are actually developing to this phase, right? So, ever since the introduction of OECD's base erosion and profit shifting, which is your popular BEPS initiative, the main principle, and I'm quoting here, profits should be taxed where the real economic activities generating the profits are performed and where value is created. Right, back in the days, value is created. A lot of people start using the term value creation, right? That was a term that was used pretty frequently, which implied that contractual allocations of risks is not sufficient already, and that the substance and the actual behavior of the parties are essential within this principle, right? So now we're talking about substance over form, where the contractual allocation of risks can be overlooked to give preference to the substance of the transaction, right? Gone are the days where your big MNCs, Apple and so on, where MNC can set legal contracts in relation to their related party transactions that may not be reflective of the economic reality to shift profits between jurisdictions. Right now, the real shift is the expectation that contracts should reflect what's happening in reality, right? That's the main principle that we're looking at today. I think you're muted. Adrian, I think you're muted.
Maybe I shouldn't mute myself. So how would tax authorities address substance, given that they have the right then to overlook contracts? And I think this is one of the reasons why it's so important to plan in advance, because doing substance post something has happened is quite difficult. But maybe I let you just elaborate more on this point, and what is it that the tax authorities can view or review?
Yeah, as you guys are aware, the first point of contact would be your contracts that determine the risk allocation, right? So throughout our webinars, we have emphasized that contracts are one of the main documents that the IRB will request and assess. That's why it's crucial to ensure that the contracts that are prepared to actually accurately delineate the related party transactions and reflect the economic reality. Right. So during an audit, the tax authorities, the IRB will come in. It will not just look at contracts. It will also look at assess the actual behavior of the relevant parties to make sure that what we have documented down in the contract is consistent with the actual behavior of the parties, right? The economic reality, which means we will need to have a robust and detailed function analysis to explain the functions performed, your risks, your assets employed by the company, right? This is also a good exercise for the company to actually understand its own functions and whether there's a need for a restructure if there are any discrepancies, right? So for your function analysis, it should also include analysis of the risks, right? The two key considerations are companies should exercise control over the risks, right? This means that it should involve the capacity to make decisions to take on the risks, where the company has employees or directors who have authority to and effectively perform these control functions. And then the second thing is actually the financial capacity to assume the risks, right? In practice, you'll be assuming the final risks where the entity that would face the consequences if that actual risks materializes. That's where you can see which company would have that financial capacity to assume that risk. Right. Once you have a detailed function analysis, you would have a greater picture on the substance element in each entity within the group and where value creation lies within the supply chain.
Thanks, Hongchuan. So why do you think then, just to give a couple of points, it is important to kind of think upfront about your business model?
Yeah, I think we also emphasize planning again, right? With proper analysis, it actually allows us to actually plan upfront in relation to the impact of various taxes, not just your TP, but various taxes in relation to your business model, so that you could then make informed decision as to whether you want to restructure your business model, depending on the impact of those taxes or not, right? Secondly, transfer pricing is all about telling and building up a story behind that actually makes economic sense, right? So we need to plan to have a coherent business story across the board, from your contracts to your TP documentation, and then to the personnel involved in relation to the function analysis, right? So all these three should be consistent, right? After all, the IRB will be conducting the same exercise that we are doing right now. And you will not want to be caught off guard when there's any inconsistency when they come in. Then lastly, with good governance on tax and TP, it will significantly reduce the risks of tax and TP adjustments in the future. And planning ahead actually makes logical and economical sense for the company, right? The initial investment may seem daunting at first, but down the road, down the track, it will be worth your while once you've done your planning accordingly.
This is where we always say that the planning exercise helps a lot with building confidence as well, because if you're looking at things when already happened 5 years ago and they're still ongoing, there is less chances to fix whatever issues that you have to fix. Whereas if you kind of look at things from the start, then it's a lot easier to make sure that there is not an overlook on any of the tax or transfer pricing regulations. Hongchuan, so what is, in your experience, some of the common pitfalls that we find, or the common issues that we find among taxpayers?
Yeah, I think one of the main risk factors that we have faced are when we go in business models. There's a business model mismatch between their TP models against the operational models, right? When you preach one thing in your TP model and then your operational model does a different thing, right? Then when there's a mismatch and when the IRB comes in, they can easily find fault in that mismatch. And then you risk adjustment or recharacterization, depending on how bad your mismatches are between your business model and your operational model. And the second one is when you have transactions that may not occur between third parties, then you have to be mindful and ask yourself, in an independent situation, would a third party transact with each other in such arrangement or not, right? That's the first question you ask. And then also atop that, you may have lack of comparables that in terms of, you know, you're going to benchmark your transactions, then the lack of comparables may not help in that case, right? The third one is, as you mentioned earlier, on the substance. Companies that were deemed providing a service, but then in reality, when you're going to perform a functional interview, you realize that, that there were no employees within that company providing such service, right? In that scenario, then you wouldn't have that economic substance in that particular company, right? Then when IRB comes in, they perform the same exercise, and then you risk a recharacterization by the IRB again, right? And lastly, nowadays, the IRB is very well versed in TP and have the experience in all the traditional industries in Malaysia, right? So I think it would be foolish to think that we could actually confuse them with a lot of figures of different types of business models, and to think that they do not know their stuff, but actually they actually do know their stuff.
Yeah, that's a very good point. I think that's one of the reasons why over the past, I will say, 5 years, audits have ramped up on TP as well. But let's look at these examples, so maybe we can elaborate on these risk factors and how a multinational group can fall within these risk factors. So if we look at this case study, we have company A located in Malaysia in a non-Labuan territory who does distribution and manufacturing. That company may sell some products to a company B located in Singapore that is a distributor. And company A potentially sells to customers in Malaysia, and company B sells to customers in Singapore. And we also have a company C that is located in Labuan. And company C, as per the contract, provides strategic management services to company A and B, and obviously charge a service fee. And that service fee is deductible in the hands of company B and company A. So if we are looking at from Malaysia point of view and the non-Labuan entity in particular, Hon Chun, what if company A was going to go under audit in Malaysia, what will be some of the risk factors, as we explained before, that can come into place in reality, and what will be some of the points that someone has to consider?
Yeah, I think in this example, I would focus more on the substance issue at hand that I discussed earlier. First, the IRB we'll be looking at. All right, so we have two transactions, one to Labuan and one to Singapore. Right, first to look at the Labuan entity. We'll discuss on the Labuan entity, which is in the lower tax territory, providing the so-called strategic management services. Obviously, there's the Labuan side of rules regarding substance, but that being a moot point, the IRB will be focusing on the economic substance under company C, right? Whether company C has the employees stationed in Labuan providing strategic management services, and whether this service, the nature of this service, benefited company A in its operations, right? So that's the first thing they'll be looking at, whether that's a service and whether it's benefited Malaysia. And then obviously, secondly, they'll be looking at whether if it's indeed benefited, what's the cost base? Is it underchargeable, not chargeable? That's on the services side. But on the substance side, that's the way they'll be looking at. That's one point. And then the second leg is, the selling, right? Selling from the Malaysian company to Singapore. The IRB will be questioning why. Then why would Malaysia be selling it to Singapore instead of directly to the customer. What's that reason, commercial reason behind this, right? Bear in mind that Singapore is also a lower tax jurisdiction. Right now, I think all this will be looked at by the IRB on the substance wise. And then now we're not saying that these business models are wrong, right? You can construct any business model that you desire. But the main point here is to plan ahead and address any substance or TP issues upfront so that you don't face any issues down the track, right?
Yeah, I think that's a very good point. Even from Singapore point of view, being lower tax than Malaysia, but not lower than Labuan, IRAs will also have an issue with these services being paid to company C. And I think the view will be very similar to the IRB as well, which is like, okay, if you're paying a service charge and you are deducting that service charge out of your assessable income or taxable income in Singapore, you also will need to prove that there is also people that are providing that service in Labuan, and it's not just a contractual liability, and that there is obviously a substance in terms of people performing, a necessity to have that service, and what is the economic value of that service for the recipient of the service, which in this case is company A and company B. So I think, as you were saying, I guess to be always mindful of staying a way of planning a particular model just based on contracts alone. I think there has to be some commercial basis behind any business model and any type of transaction, and that's what you can ensure when you do or plan your business model upfront. So let's move on to basically some of the key TP issues that any taxpayer will have to address. And maybe if you want to share some of the key TP issues that in your experience, for example, a company A in our example before has to consider.
Yeah, I guess these are the list of things that taxpayers need to be mindful of on these key TP issues. First up, you need to assess the type of related party transactions that you have, right? And delineate the nature of transactions. If you look at the examples before, right? We have strategic management, we have distribution, related party transactions as well, right? First, you need to look at what's part of the type and what's the nature of that transaction. Then after which, you then need to analyze whether the transactions are consistent with the arm's length standard, by way of standard substance, and then also would an independent party actually transact in this type of arrangement or not. And then you need to support it by way of benchmarking or TP methods that you select, the most appropriate TP methods you select. Then you need to then assess the extent of documentation that you have prepared. Right. So obviously the main thing is TP documentation, or there may be other documentation such as your TP policies for the group as well in relation to the type of transactions that you may have within the group. And in Malaysia, you also need to assess the domestic transactions, where both companies in Malaysia have different tax rates. The previous example provide you a good view of what it means by domestic transactions with different rates. When you have the Labuan versus non-Labuan, there are also circumstances where you have loss-making companies, or you have incentive enjoying entities within Malaysia as well. So this needs to be looked at. Then contracts will need to be properly documented with all the analysis and the delineation of transactions that you have put in place from the planning phase, and then put inside contracts to be properly documented. And obviously the overall objective is to minimize your TP risks as much as possible through planning, right? Once you've planned it, that's one of the main ways to minimize your TP risks. And lastly, apart from transfer pricing, you need to assess other tax-related issues as well, like your withholding taxes, your corporate taxes, SSDs, or nowadays there have been talks about GST being implemented again in Malaysia. I understand that GST are being increased in Singapore, Adriana. Yeah, so I think Malaysia may want to implement GST.
In addition to sales tax.
I'm sure they will abolish this SST and replace it with GST. Oh, that's another
okay.
tedious work.
Oh, well, okay, so maybe let's just talk about this now that we have kind of define some of the issues, and in theory, why don't we just go through the examples and then kind of explain how this works in practice. So maybe we go first to the service providers, and then basically what are some of the key TP risks. Maybe I'm gonna go through an example and then some of the key tips to manage those type of risks.
Yeah, I think it's a good thing that we put service industry up front, because service industry is actually one of the big areas that RRB is looking at. A lot of controversies behind services transaction, and most definitely the most challenged transaction that we have experienced. Now, we have recently attended a tax webinar, and RRB has raised this issue where a lot of taxpayers have no contracts in place for their related party transactions. Now, without a contract in place, that alone does not provide confidence in a taxpayer's TP governance to the RRB. And then you would risk RRB would be performing or would be more stringent in their audit exercise, right? We would like to try to avoid that as much as possible. And then there are discrepancies on your chargeable versus non-chargeable activities, where the definition of non-chargeable services can differ from different jurisdictions. So it would be great to reassess the definition of services, whether these services that you are providing or receiving are non-chargeable or not, right? Next, we have issues with evidence of benefit tests. Now, benefit tests can be increasingly subjective when you have layers of services between entities, from your head office to your regional to your local. Then you risk having some of the services being deemed as non-chargeable services, which you will like to avoid. Hence, it's crucial to properly document the nature and the benefit of these services. Then there are also service issues with cost base, right? Another thing about this issue is that a lot of taxpayers focus a lot more on the markup than the cost base itself. But little do they know that cost base actually form a majority of your fee, of your chargeable fee, right? So taxpayers tend to lump all the cost centers and include it all into their cost base without properly assessing whether within the cost base, does it include non-chargeable costs, right? This is one of the areas that you guys will need to look at and make sure that all the non-chargeable costs are actually excluded from your cost base. Then lastly, of course, we have your appropriate allocation keys and markups, which get asked a lot of times. These will need to be assessed in more detail in respect of the respective type of transactions that you're providing. And one of the constraints is that it may burden the taxpayers in searching for the most appropriate allocation keys. And the search for the most appropriate allocation key can be a challenging exercise. So please be mindful of that, which leads us to the question of loss-making service providers. Obviously, now we are in the COVID era. There are a lot of entities that are in loss-making position, but in theory, in particular, routine service providers should be remunerated on a fixed markup or a fixed margin on costs, right? By right, routine service providers should be making a profit. Having said that, proper commercial analysis will need to be performed in this case to, justify why the loss-making position of that particular routine service provider.
Thanks, Hunch. Now I didn't forget to unmute myself.
Yep.
Thank you. So how about we look at these examples, so maybe some of these points can be a bit clearer. So let's talk about, for example, a global head office located in the US, and company A regional head office located in Singapore, subsidiary D, which is a Malaysian shared service center, and another couple of subsidiaries located in Vietnam and Thailand. And let's assume that we have a series of services or intragroup services happening within the group. So let's say, for example, global head office charges a global support for the whole Asia region to the regional HQ Singapore, and this regional HQ also receives some of the services from the Malaysian Shared Service Center, but the ultimate recipients of both the head office service and the shared services are Singapore, company A, and also the subsidiaries B, C, and D itself. So we have potentially two service providers here, which is the global head office in the US and the subsidiary Malaysia Shared Service Center. And we have potentially a company A in Singapore that may be also a provider or may just be consolidating the services to be recharged to the whole Asia Pacific region. So how would, if we look at this in the context of subsidiary D, which is the Malaysia Share Center, what would be some of the issues?
I guess from this example, obviously there are a lot of jurisdictions. On a Malaysia's perspective, first we'll look at provision side first, right? Provision perspective in relation to the type of services provided by Malaysia, right? First thing we'll look at the substance requirement, whether they're employee stationed in Malaysia providing services to wherever the recipients are. In this example, it seems to be to just Singapore, right? There may be questions later on, but after which then you need to assess whether the cost base charged by Malaysia, does it only include chargeable costs? And then obviously the arm's length markup on costs, right? That's the provision of services side, right? Assuming it's providing services to Singapore in this example. And then obviously on the receiving end, that's where the complication starts. We are looking at global head office charging $200, then to Singapore regional, and regional to Malaysia, maybe 100. So from then end, IRB will start asking what services are actually provided by Singapore, whether Malaysia has benefited from such services for their operations. And the next thing is whether such services should be included in the cost base of Malaysia from the provision of the shared services. Right, there are a lot of questions that IRB can ask within this example.
How about, for example, let's assume that subsidiary D provides share service not only to Singapore, but also to the subsidiary B and subsidiary C, but the invoicing is centralized only to company A, meaning subsidiary D invoices only company A, which is Singapore, and then company A push down all the costs among all the recipients of the service. Would IRB have a problem with not invoicing or not issuing the invoices directly to the recipients of the service?
Yeah, I think we have a lot of arrangements like this where you have one entity acting as a centralized invoicing entity, right? The main the importance of this is to make sure that under the TP documentation of Malaysia, you have to properly delineate the nature of transactions, the recipient, right? And also, more importantly, the commercial reasons why you have such arrangement, why having a centralized, in this case, Singapore as a centralized invoicing entity, and then charge back to subsidiary B and subsidiary C, right? Obviously, one of the main commercial reasons would be that having a centralized invoicing will be cost effective, but as long as the costs incurred in providing the services are all charged out to Singapore as an invoicing agent, and then charged back to the subsidiary. Then on Malaysia's perspective, yeah, essentially charging all the services out, the appropriate chargeable services out of Malaysia and remunerated accordingly.
And coming back to a typical example, a typical question that we get asked. So will that shared service center be able to make a loss, or under which circumstances would be able to book a loss?
Generally speaking, if you look at this example, Malaysia would be deemed as a routine service provider, right? Meaning it will have a cost base as a fixed markup, right? But there are circumstances where if you look at the receiving end, so apart from providing that service, you look at Singapore is also providing services back to Malaysia, right? Then the question is also another equally important is when you write up the contract, right? Whether the costs charged by Singapore, the regional costs, is it included in the cost base, right? Generally speaking, it should be included so that the Malaysian shared center would be remunerated on that fixed markup and should be profitable.
Yeah, fair enough. Okay, so maybe before we move on to manufacturers and distributors, just some wrap-up tips, Hon Chan.
Right. Yeah, just a recap. So basically, I think it's good to have a step by step. Right? So first, you define the nature and which entity to perform. That's your economic substance. Then you look at your cost centers, make sure that these are properly defined and does not include any non-chargeable costs. After which, you have to ensure that you have selected the most appropriate allocation keys if it's more than one recipient, and then the correct arm's length markup for the correct service transactions, right? Once you have the first three elements in place, it's crucial then to document all this into the contract, right? So that all the above are consistent throughout. And once you have the contract formalized, you can then prepare TP documentation, your contemporaneous TP documentation, and then perform your necessary arm's length analysis. And then once you've done that, lastly, which is more of a trap, to watch out for lump sum or fixed payment with no basis, right? This can be a flag to the IRB. The reason being because when you have a fixed payment, let's say, oh, I'm going to charge 50,000 worth of management services to my related party. When IRB see a 50,000 fixed fee on a service transaction, they'll be thinking, well, most likely you will not have done your due diligence, or you're looking at your cost base plus markup. Because generally speaking, you'll not come up with a fixed fee when you have a cost base, a variable cost base and a markup itself.
Thanks. I think that last point is very important, because the number of times that we see at very early transactions being agreed on lump sums, and then when we need to explain to a tax authority, okay, what is the basis for the lump sum, then usually the company does struggle to explain. So that's something to really watch out for. So let's talk about manufacturers. And I guess the challenges are somewhat similar, but there are some peculiarities of issues that are usually faced by manufacturers. And what are those key TP risk or issues? So I think one is usually having or not paying attention to the importance of the type of manufacturer. As we will explain in our example, the type of manufacturer can really have an impact on the profit that is left in a particular country. Hence the reason why is quite of an important factor to define very early in the contract. The second point is definitely that there is a struggle to understand the interrelation between the internal pricing that the manufacturer decides to put in the products that it manufactures versus the tax impact and the TP price. Because a lot of the times companies may think that, oh, okay, any manufacturer will do maybe cost of manufacturing plus a markup on the cost of manufacturing, but then the cost of manufacturing, there is fixed and variable cost. So the question is, how do you factor in the variable cost? And how can you forecast that variable cost as accurately as possible so you don't have to do too many year-end adjustments? So the third point is obviously the lack of contracts in place. And I think this is a one that, again, it's overlooked a lot, but it has a lot of importance because even in some of the court cases that you read about manufacturers, the factor to determine, or the key aspect to determine whether the manufacturer was a full risk or a contract manufacturer is based obviously on the people and the functions performed, but also on how the contract was drafted in terms of the risk and responsibilities. As I was saying in my point earlier, one of the traditionally most manufacturers, you will do a cost plus a markup, but then the question is always, what do I include in my cost, fixed, variable, and how do I forecast my variable correctly? And obviously the last point is always, if depending on the type of manufacturer, if it's just a routine manufacturer such as contract manufacturer with guaranteed profit, then you might have to take into consideration the fact that you may have to do some year-end adjustments and true-ups to reach the arm's length profitability. But that can have some risk because you will, apart from just doing a credit or a debit note, you also have to take into consideration that if there was imports or if there was exports, you may have to deal with custom duties and other taxes as well. So if we see this example, we have a company A, manufacturer and owner of the IP, located in Germany. We have company B located in Malaysia and company C located in Indonesia. Company B being a manufacturer and a distributor for the Malaysian customers, and Indonesia being a manufacturer and distributor for Indonesia. And we might have some product supply coming from company B to the company A, which is the owner of the IP, maybe from company C to company A, maybe from company B to company C. Now, one of the first aspects that we need to understand here is, okay, what type of manufacturers are these companies? So we know that given that we're saying that company A is the owner of IP, the chances are that most likely this is going to be a full-fledged and entrepreneur manufacturer. Now the question is, if this company A is the owner of the IP and the entrepreneur, the question is, okay, why would company A set up manufacturing plants in Malaysia and Indonesia? And probably there could be different reasons. One could be supplying the local market, not only Malaysia, but the region, or maybe product specialization in different countries to be able to produce more volumes, because generally one of the key issues that any manufacturer will face is production capacity. There is a point that any manufacturer wants to grow, they have to grow outside of the country because there will always be production capacity issue and the need to basically produce faster and somewhere more cost effective. So then if this is the entrepreneur, then the question is, if I was planning in advance, what do I do with my manufacturers B and C? And I guess it depends of what level of control, supervision, and mandate I give them. So for example, if I decide that in substance, they need to be just a contract manufacturer for the products that they source to me, then I have to define that very clearly in the contract, because in the context of a contract manufacturer, that contract manufacturer is basically a doer who is doing or executing a task on behalf of the main manufacturer, which in this case is company A. So that needs to be defined up front, because the level of responsibilities is limited, the level of risk is limited in terms of, for example, product liabilities, and therefore the remuneration will be on a routine profit but continuous profit basis, right? And that also will apply for what we call toll manufacturers. And because those toll manufacturers or contract manufacturers are just doers on behalf of this company A, then there will not be any room for royalty payments to the owner of IP, which is something that we get asked a lot. So can a contract manufacturer pay a royalty to the owner of the IP? And the answer is no, because the contract manufacturer is not having a license to exploit the manufacturing know-how on a standalone basis. They're just a doer on behalf of company A. On the contrary, if we decide that company B and company C are going to be a full-fledged manufacturer, then the contract needs to be different, because it will be just a standalone supply contract. Well, there will be a lot less supervision and control from company A, and they will be basically responsible for their own operations, from operational risk, funding risk, etc. And if that's the case, then there could be some room to pay know-how manufacturing license fees to company A. So that's why defining this upfront, it is important to be able to define whether I'm just going to park routine profit in Malaysia and Indonesia, and anything above routine is going to return back to company A, or if I'm going to leave company B and company C to be self-sufficient, and then at some stage just pay me a royalty for the exploitation of the IP that I'm allowing them to exploit. I think that's pretty much some of the key points when it comes to manufacturers, but maybe I leave it to you just to say a few wrap-up points on this.
Yeah, I think, if you look at, all these manufacturers, right, the main thing that we have discussed earlier is that, the detailed function analysis that we need to prepare. That's where the concerns lie, right? That it's all good, well and good if the Malaysian part, right? The Malaysian manufacturer is not. It's just a routine, basically operational side and manufacturer itself. But there are circumstances where you need to perform that function analysis, where some companies, some Malaysian companies, manufacturers, they have, product design team, product development team within their the Malaysian manufacturer. That's where you need to be mindful of, to make sure what's that function within Malaysia does. Are they developing it, or are they improving it? Right. That further complicates things as a whole when you have characterizing the manufacturer for Malaysia or other parts of the country. Right, which leads to the first part, define the type of manufacturer. That's where we need to make sure that during a planning stage, ensure that your business model as that what type of model or type of manufacturers that you want the Malaysian entity to have, right? And which leads to the responsibilities and risks in relation to characterization of the manufacturer. Similarly, we need to make sure that all these are documented down in that contract. And then obviously in the contract, you would have that the calculation of that grid price as well to be in the contract so that everything's consistent throughout. And then you have your TP documentation, then performance analysis, nature. And then as Adrian has mentioned earlier, always watch out for true ups at the end of the year and adjustments in relation to other taxes apart from TP for manufacturers.
Thank you, Honcho. And then for the last part, let's talk about our all good distributors. And the reason I say all good distributors is because probably is one of the most common business models or transactions that you will face. I think the TP risk is somewhat similar to the manufacturers because, again, the type of distributor can drive the level of profit that is left in a particular country. You again have the same issue of the internal pricing versus tax and TP, mainly because I think if there is one practical knowledge that every transfer pricing practitioner knows is that a lot of the times distributors, even if they do internal pricing via a resale minus or working from customer price via discounts, etc., the tax authority will always expect to look at the net profit return of the distributor. And I think this is probably one of the most, how do you call it, consistent approach in the region that probably every single tax authority will expect that. Coming back to similar point that there has to be some contract that justify the responsibilities and risk that the distributor assumes to justify the type of distributor. Another point, coming to my initial point of the net profit approach, is that tax authorities tend to challenge a lot distributors that are in loss making positions, especially for 3 years plus. They tend to be reviewed. I will say that that's the winning combo to get a TP audit, together with very high transactions values. And then obviously, you have to also watch out for the year-end adjustments and true-ups. So if we see this example, let's assume we have a company A located in Singapore, which is a regional procurement and sales entity. And this company has also two distributors, one company B located in Thailand and company C located in Malaysia. So if we look at it from Malaysia point of view, the question is, if assuming that this company C only does distribution for the products that it purchases from company A, how will IRB will look at it? And I think we can have 3 different scenarios here. And for that, we brought up here what an example of what an interquartile range will look like. And this is just disclaimer here. This is not coming from a proper benchmarking study. This is literally come from the sky. So don't take this as being a correct interquartile range for distributors in Malaysia. It's just an example brought from the sky to for teaching purposes only. So let's assume that the interquartile is 2 to 5% with a median of 3.55. And let's assume that this distributor is trying to either do planning or checking its forecast operating margin up front, or maybe testing after the books have been closed. So you can have an scenario number 1, which is the company earning an operating margin of 5% and clearly being in the upper quartile. So obviously this is a low risk scenario, because if you are within the median and the upper quartile, the chances are that IRB will be okay with that result and will not be likely to have some anything is possible, but any TP adjustments, unless your comparables are crap, and then your data is not objective. You can have a second scenario, which is basically where we have a 2% operating margin where it is toward the lower quartile. I think in this scenario, I will call it like a medium risk type of a scenario, because you will have been following towards the lower quartile. So you have to explain why your operating margin is not closer to the median. And maybe if you're using some comparables that are full risk and maybe your distributor is a limited risk, maybe that is an explanation to say that that's why it should be towards the lower quartile. And then the third scenario is probably the high risk scenario where the distributor is outside of the range. It has minus 1%, which means that is in losses or in operational losses. So for this scenario 3, then that distributor will be in a lot more or in a higher risk of having a TP adjustment, because IRB will try to look at some industry benchmarks. And if the industry has not been suffering, and if this distributor is not full risk, but is maybe routine or limited risk distributor, then IRB will have a very hard time understanding why the distributor is on losses. So my point in scenario 3 is not that is necessarily wrong. It's just that the distributor will have to explain very clearly why it has to assume those losses, point number 1. And 2, what are the commercial factors other than purchases from, in our example, Singapore, that can result in these losses, other than transfer pricing. Otherwise, you will struggle with explaining with IRB. Or to IRB. So what will be just the final points from your point of view, Honcho?
I guess the tips are very similar to manufacturer, but I just want to re-emphasize on the definition of the type and responsibilities and risks, right? These two ties together. The reason why I think it's important is because you need to make sure that you characterize your distributor accordingly, right? You wouldn't want to risk IRB coming in, and then we look at your functional analysis, and then we characterize your the characterization of distributor, right? You may have characterized as a limited risks, then they recharacterize you as a full-fledged, right? Then the remuneration on those two are very different, right? Quite bad end for distributors.
Yeah. And I think this point is very important, this type of distributor, because in our scenario 3, where we have a loss making, if that distributor is not a full-fledged, you will struggle to explain to IRB why do you have to assume the losses. And that was one of the points even during COVID. There was like, okay, if you're a limited risk distributor, why you have to assume losses? Shouldn't that go back to your parent company? Okay, so maybe just a couple of wrap-up points, Hon-Chan, before we go to questions.
Yeah. So as we have mentioned, TP planning is key. And then substance, always you need to make sure that you have economic substance in all your dissertation and the respective entities. And then thirdly, detailed functional analysis will help you along the way to make sure that you know your stories and it's actually coherent with all your documentations. And lastly, legal agreements, very important. First thing, you need to make sure that you need to get that formalized as soon as possible.
Thank you. So we have 3 questions in the audience. So maybe I start with number 1. So the question is, as a distributor who sells products manufactured by its related manufacturer, how to account for the marketing intangible from TP perspective? Any difference in these regards if the intangible are not patent?
Well, actually, marketing intangibles is actually showcased in the TP guidelines, Malaysian TP guidelines, right? So I think in your question, it really depends on whether there is a trademark or not. You will need to actually perform with the so-called DAMP analysis in relation to intangibles, which is development, enhancement, maintenance, who developed, whether there's actually intangibles in place, and who develop, enhance, maintain, protect, and exploit those intangibles. Then only then you need to assess on whether intangibles should be accounted for, right? That's the first exercise.
I think one point that maybe is also worth mentioning is that whether you have registered your intangible or patent your intangible doesn't necessarily has impact from TP point of view. I guess the definition from TP point of view is quite broad, and it has to be something that is of economic value and is not common knowledge, but it doesn't require actual registration. So there is another question. Usually management fees are charged on a lump sum annually. Will this be an issue?
Yeah, I think as I mentioned earlier, a lump sum, unless for some reason or coincidentally your formula every year has come up with the same number on your cost base and your markup, generally speaking, it shouldn't be on a lump sum figure.
I think maybe this person is getting confused, because what we understand for lump sum is in the agreement, agreeing that is $100. Right? But your invoice may be just a lump sum because your charge is $100. It's just that if that $100 in your invoice have been agreed in the contract that is $100 and there is no basis, then that's the problem. So the problem is not per se to put $100 in an invoice. The problem is agreeing in a contract that is $100 that goes in an invoice, and then there is no basis for it. So that's a fair distinction, but because what we were talking about was not in the invoice itself,
more on the fixed.
Most on the calculation that supports your invoice. And there is one more. In the absence of internal comparables, how does the manufacturer benchmark the markup percentage for TP purposes, as such information is very hard to search for, especially cost methods has been adopted for TP purposes? Any suggestions in this regard?
Suggestions do you have, Adriana, on finance?
Sorry?
No.
Yeah.
Well, I'm not say.
Yeah, I'm not too sure what this person means, because we found that benchmarking for manufacturers is possible, right?
Generally speaking, unless you're in a niche product area, right? So that's where the complication increase, where you're in a very niche industry.
Yeah, that could, but usually, to be honest, finding industry benchmark of manufacturers is not, I wouldn't say it's super easy, but it can be done.
It can be done,
Yeah.
yes.
Okay, so there is no other questions, but just a couple of points just to tell everyone. If you want to look at any other of our webinars and videos, you can subscribe to our YouTube channel. We have a lot of content there on training and technical aspects of TP. We have a big agenda coming in July and August, lots of webinars coming in July with top tips for small multinational enterprise, 21st of July. We also have Managing TP in Asia, 12th of July. And we have in August, top 10 tips for managing intercompany loans. And our very exciting news, which is our TP series of workshops with the Malaysian Institute of Accountants that will be basically organized by MIA. And we will probably publicize it in our events as well. So stay tuned if you want to attend. It will be a series of 3 workshops of 3 hours each, where we'll be talking about TP essentials, TPs in Asia, and also operational TP. And I think with that, we are pretty much done. Thank you everyone for making the time to attend today to our webinar. Stay tuned for our upcoming webinars in July and August.
Right.
And that's a wrap.
Thanks, Adriana. Thanks, guys.
Thank you.